Hi, my name is Janice. Welcome to my channel. It's great to see you. If you like this video, please click the like button and subscribe to my channel. Okay. Today, I would like to share what I've been thinking the past few days on what kind of investment research will be actually timely and critical for you to help you with your high inflation situation right now. In fact, worldwide, we are having all the high inflation prices. So you might be asking, is tech stock going to recover? Can I buy tech stocks for short term? Tech stocks are unlikely to recover soon. Major players in the world of tech stocks saw huge losses. Meta, now Facebook, lost 2/3 of its value, and Tesla saw similar drops. Amazon lost half of its value. Tech stocks fell more than 30% in 2022, more than the overall market drop of 20%. A lot of well-known tech stocks, companies are also retrenching people. This is showing that tech stocks will keep dropping. So what is actually causing the killing of the bull market, you might be thinking? Is it because of inflation? Actually, it's not just inflation that caused the stock market to drop. It's actually the Federal Reserve response to inflation to increase the interest rates that cause the share prices to drop. So it's actually the Fed response to inflation where the market is going. So write it down. Companies that rely on low interest rates, loans that was previously available for them to continue to run their businesses will actually suffer. Because the interest rates keep rising, they don't have access to low interest rates anymore. And you see companies start to cut costs, as I said, retrench people, and then some companies went to liquidation and close down. Today, I will help you to handle the situation and to work against the inflation, the problems of inflation, and how to help you with it. If you're a beginner, not to worry. Welcome to hear and learn how to go about working towards fighting inflation and all that. So be glad that you are here. And then if you're a seasoned, experienced investor, you can still learn something one or two. I hope that it will help you. Please share your knowledge as well in the comment section below, since you are experienced investors. And we can have a good discussion together with other viewers who are new in investing and all that. So if you'd like me to continue to help more people and produce more useful content and grow my channel because it will help to benefit others, please subscribe to my channel and like my video. Now, please get ready a pen and paper to write down some important points and terms you might not be familiar with, which I will be covering. So I'm going to teach you some skills to profit from inflation. First thing is to take note the Fed scheduled meetings each year. This meeting is called FOMC meeting, Federal Open Market Committee meeting led by Jerome Powell. Each year, they will have 8 meetings to discuss about job market, inflation, and then take action based on the outlook. If you want to know what is inflation going, where is inflation going, we always read the Fed response on it, the statement. Okay, read the statement. So they will have a meeting and then they will discuss and then what are they going to do and then the statements, outlook and all these things. So let me show you the website. You can visit to find where to get the statements and the scheduled meetings. Okay. Let me share the screen. So this is the website, federalreserve.gov. Over here, monetary policy. So this is the website. Over here, you can see the schedule for this year, 2020, the FOMC meetings. So here, the 8 meetings schedule. Okay. And then last year meetings, you can actually read the statement over here. Okay, statement. Over here, you can actually click and view the statement. Okay. Use the statement over here. And you can look at the minutes. You know, look at the minutes. There's a lot of information over here. Okay. At the press conference, press release. Okay. You know that. So this is for January. Let's look at maybe the latest one, which is in December. Okay. December last year, which is recent. Let's look at the projection materials. So talk about economy projections. And then there's a table over here. Okay. So table over here. This table is very important. We will look at terms of the PCE and the core PCE inflation rate. Okay. PCE is actually personal consumption expenditure. Okay. Right. So yeah, let me continue on. So these are actually important data to see about the Federal Reserve meetings and looking at the statements. Don't just rely on the media headline news read. You can read the media news only after you read the Fed Reserve statements, read the full details, read the minutes, read the reports, read the projections and all those things. Get the facts rather than the opinions from the media, because the media may have their own opinions that is actually maybe different. Okay, so looking at the statement report for the PCE inflation, as I mentioned, PCE is actually personal consumption expenditure inflation, and then the core PCE inflation. Maybe you want to write it down for those who are beginner. So look at this, the PCE inflation and the core PCE inflation. So the main thing that Fed looks at is actually the core PCE inflation. So maybe write down core PCE inflation, very, very important. So based on this core PCE inflation, to decide on their decisions. So let me show you what is core PCE. Okay, core PCE. Core PCE. Core PCE price index, right, is actually referring to personal consumption expenditure prices, excluding food and energy prices. Okay. The core PCE price index measures the prices paid by consumers for goods and services without the volatility caused by movements in food and energy prices to reveal underlying inflation trends. Okay. So basically, it's actually not including the food and energy. It's basically looking at the goods and services. Okay, so that's actually core PCE price index. Right. Okay. Then let's look at the components of the core PCE. What does it comprises of the items in the food, goods and services? Okay, let's look at it. Okay, let's look at it. It's actually this table. Okay, this table over here. So basically, the PCE is based on these goods and services, the core PCE. The goods and services is actually including like motor vehicles, furnishing, recreation goods and services, things like that. And yeah, and then services include like healthcare, housing, utilities, transports, recreation, financial services, insurance. So these are the examples of the core PCE goods and services that Fed will actually look into at. Okay. So now look, you have to look at the right-hand side. Right-hand side, the values, the corner. Notice the data, which shows about the inflation influences. Okay, the data for the year. So you can see the increase in prices over the years. See the inflation rate. And yeah, just pay attention to where the inflation is going. So it's like keep on increasing. For example, motor vehicles. Okay, motor vehicles prices, it keep increasing from 123,343 to 124,568, and then to 126,768. So it just keep on increasing. Okay. And then the healthcare sector is also the same, increasing 1.7, 5.9, 1.7, 968, and then 1.8, 903. So look at all these categories and the inflation data. Right. Now let me show you the latest PCE forecast in December 2022. Okay, I'm going to show you a slide. Okay, the core PCE is actually, inflation is actually 4.8. And then the PCE inflation is actually 5.6. So basically, what this means is actually on average price of goods and services are actually increasing by 4.8%. Okay, which is very high. So a healthy inflation rate is actually about typically around 2%, which is the historical average. Current inflation rate is a lot more. This means things are getting more expensive. Are your wages increasing each year to actually match the increase in living expenses? If yes, it's actually good for you. If no, keep listening how to actually work on improving yourself to fight against inflation. We might be hearing people say that buy property, real estates, and rent it out to fight against inflation. This is great if you can actually afford to do it, but not everyone can afford to do it. As the mortgage loans are still high, houses are actually at skyrocket prices. Buying a more expensive, bigger property may not be necessarily good thing for you, as it results in higher property taxes. Do you know that? Which you have to pay each year. So most people forget they need to pay the taxes as well. So, and then when you buy high now, the property prices is actually overvalued. Okay, overvalued. So and then you have to think about renovations and repairs if you buy your own property. So you need to factor all these things. So your payment is actually not as great if you buy high expensive property. Okay, so because you have all the expenses you incur, you know that. And then if you use mortgage loans, and interest rate is actually very high now. Mortgage rates are very, very high. Okay, so it may not necessarily be means good to you if you buy a property that is high, but those who have your own property and then you can rent it out. Rental income is good for you because rent is high now. But if you want to invest in another new property, unless you have a lot of capital on hand, you don't really need to have mortgage loans and all those things. Maybe you can invest, but as I said, you have to look in terms of your taxes, your property tax, renovations and other costs. Wise and do your own calculation, okay, to do that. Now, how about the stock market? You might be asking. Let's look at the S&P 500. Okay, let's look at the S&P 500 portion. The S&P 500, right, is actually comprising of 11 core sectors. Okay, 11 core sectors. Which are the core sectors? In this table over here, your left column under the sector name are actually your 11 sectors. Okay, the IT, information technology, the communication services, consumer discretionary, the industrials, the financials, the healthcare, consumer staples, energy, utilities, real estate, materials. So these are the 11 core sectors. But do you know that besides knowing these sectors, right, you need to know how these sectors they perform over time with inflation in place. Okay, I'm going to show you now. Okay, based on the data, the table I've compiled for you. I've broken the sectors based on the year to date. Okay, the year to date over here. So you can see that some sectors are actually doing well. And then let's look at another chart, the Schroders chart. It shows equity sectors may shelter against rising inflation. Okay, so which are the equity sectors that are sheltering against inflation? You can see that some sectors actually perform better during inflation time. As you see, the equity, energy, rates, precious metals, and mining are the ones that can shelter against inflation. They are actually up, high level of outperformance versus inflation. Okay, look at the arrow up here. Okay, look at arrow up here. All this energy, equity, and all that. Okay, yeah, energy, equity, and metals as well. Okay, metals and mining. So it depends on, but one thing is that this data I just showed you, the data is not really always precise. It depends on the particular year context. In this year, some markets may not necessarily be able to outperform. Okay, so for some areas, but for this year wise, right, I would say that energy market will still do well. Energy and the financial services will still do well. Okay. Now, you need to know that there are some general principles to remember regardless of the sector. You can write them down, these important points. First, find out, does the company has pricing power, also known as market power, in compared to its input costs? Okay. Does the company has pricing power, also known as market power, in compared to its input costs? Okay. Pricing power. Okay, write down pricing power. So what you need to do is to find out companies that have market power, the leader in the industry that can decide the prices. An example of that market power is actually Apple. Apple is the leader in the smartphone market. Okay, although Apple cannot compete control the whole market, but its iPhone product, right, has actually a substantial amount of market share and customer loyalty. So it has the ability to affect the overpricing in the smartphone market. Leading companies, right, have a stronger power to raise prices without losing customers. Customers will not just leave because they like the brand. Okay, they like the brand, they like the quality, so they'll stay loyal even though the prices are high. Yeah, so they'll still buy. And then another thing you need to know is to check out the gross margin of the company you are investing. Gross margin, the formula is actually revenue minus cost of goods sold divided by the revenue. So look at those of the gross margin. Okay, so the next consideration, the second one, is what is the company cost structure? What is the company cost structure? Does the company has fixed costs or variable costs over time? Example, companies that own real estates are likely to profit from inflation. Okay. Their assets in balance sheet going to rise up versus companies that don't own property and has to rely on rent for their office will see their costs increase over time with inflation. The results in this actually results in lower margins for those who rent. Okay, lower gross margin for those who rent. The third consideration factor is actually this question. Does the company has significant growth potential during inflation? Will the company be able to keep selling to the market at higher prices, higher market prices? Okay. Example, supermarkets, hypermarkets like Walmart, Costco in US, and in Singapore, we have Sheng Siong. Sheng Siong is a listed company. They're likely to keep increasing prices as people still want to buy groceries. Groceries are when they buy food, right? And daily necessities and all those things. People still have to go to the supermarket, the hypermarket to get their things. So another thing is they have wide resources. They have a big warehouse. They have a lot of people. They have economic skills. So no problem. In terms of inflation wise, they can still increase prices and people will still buy. Okay. So you can actually consider this sector. Okay. Now for the energy sector. Higher input costs in the form of higher oil prices will give this company that has direct exposure, commodity prices through futures contract a higher lift actually. So there's actually a proven correlation between CPI, which is Consumer Price Index, and the energy sector performance. Those companies that pose an advantage in the inflation environment, they are able to raise dividend yield. Shareholders can actually profit when they invest in energy. So, however, there is actually risk in investing in energy sector. I repeat, there is risk in investing in energy sector. During inflation time, the valuation of these companies, the valuation is very, very high and rich. It's very expensive. So I repeat, in inflation, which we are having, the valuation of these energy companies are very high, rich, and expensive. You do notice that actually all this energy stocks rise a lot now, and we were to buy now, they are vulnerable because they were likely to have a re-evaluation and re-rating when there is no more inflation. Inflation drop. There's less inflation, no inflation, or even worse, there's this thing called deflation. okay, which is actually selling because cost division. People buy things that is actually lower than the cost and all those things and all that. So with that, the prices in the energy sector will drop tremendously. Companies will be get worse off their actual losses. So I would say the energy sector is actually temporarily short term, but if the war is still going on, between Russia and Ukraine, I think the oil prices, the energy prices will still be high if the war is still going on. Okay, so yeah, but when there is no more inflation, the oil prices will drop, the energy sectors will drop, and all those things. So just want to take note of that. So you have to do yourself your own due diligence on whether you want to invest in energy sectors, because there's high risk that you might be losing money. Yeah. Okay. Yeah. For the tech sector, as in the beginning I mentioned, I just want to repeat again. As interest rates goes up, loans become expensive. Tech sector will be badly affected as they depend on low interest rates loans to operate. That's why you see the tech sector retrenching people. Revenue income missing the target, profit margin drop. Share prices in tech sector have been dropping in the short term. Tech stocks are unlikely to rebound back. Okay, so it's actually a good time to buy low now, to keep for long term. If you have the money, you can actually buy now at very, very low prices, because most of the stocks, as mentioned, drop half and all that. So it's good to invest now to keep for long term. But there's tech risk, because these companies, they may not do well long term, or they may even close down, they go into liquidation. Okay, so there are still risks involved and all those things. So again, I would say do your own due diligence what you want to invest in, and decide what kind of risk factor you can take. Okay, now to summarize, as you can see, profiting from inflation needs to have understanding the relation of input costs and where interest rates are going. Okay, I repeat, is the relationship of the input costs, your costs. Okay, the companies that you want to buy, their costs, the material costs and everything, or the costs, operating costs. Okay, and the interest rates, where are they heading? So take note on the Fed Reserve response to inflation, where the interest rates are going. So I hope that after watching this video, I believe you now knows a lot more than an average person's knowledge to prepare for inflation. And if you'd like to learn more from me, do subscribe to my channel, share it with others, like my video, and subscribe to my channel, and turn on the notification bell. Okay. Thanks for watching, and have a great day ahead. Bye.